Collateral-dependent loans. A loan that can only be repaid by the sale or refinancing of the property securing the loan is a collateral-dependent mortgage loan. A provider would be engaging in unfair or abusive practices if its loan terms and underwriting practices heighten the need for a borrower to sell or refinance the property once amortization begins in order to repay the loan. It makes loans to borrowers who cannot demonstrate the capacity to repay the loan as structured from sources other than the collateral pledged. Risk layering. A provider should offer an interest-only loan with reduced documentation or a simultaneous second lien loan that combines features increasing its risk only if mitigating factors can support the underwriting decision and the borrower's repayment capacity. Mitigating factors could include higher credit scores, lower LTV and DTI ratios, significant liquid assets, mortgage insurance, or other credit enhancements, but not higher pricing. Reduced documentation. Underwriters using full documentation to verify an applicant's income, employment, and assets will review W-2 forms, pay stubs, 1099s, tax returns showing self-employment or business income, a business income statement, proof of retirement or disability income, bank statements, investment and retirement account statements, information about other real estate and personal property assets owned. However, when written verification is delayed or not obtainable, or the borrower objects to verification, Alt-A loans have been made available at higher cost that required no documentation or only limited documentation. Types of Alt-A loans commonly used before underwriting requirements were tightened include the following. No-doc loan. Employment, income, and assets are not stated on a loan application. Only the applicant's credit and the property value are verified. Such a loan would have the highest rate. Limited doc loan. Employment and/or assets are verified, but income is not. Stated income loan. Both assets and employment are verified, but income is not. However, the underwriter will still analyze the income to determine if the amount stated is reasonable in light of the applicant's employment. If it is not, he may hold up approval unless the applicant can provide some sort of verification. These loans have come to be known as liar's loans. Stated income assets loan. Employment is verified, but not assets or income. Bank statement program. For borrowers who are self-employed or paid on commission, the underwriter calculates income based on deposits shown on the applicant's personal or business bank statement for a specific number of consecutive months rather than on his pay stubs. For wage-earning and self-employed customers, income is calculated based on average monthly deposits over a specific number of consecutive months as reflected by the borrower's most recent bank statements for that time period. For those who qualify to submit business bank statements, income is calculated based on 75% of gross deposits over a specific number of consecutive months as reflected by the borrower's most recent bank statements for that period. No ratio documentation loan. For all of the other no-doc or low-doc loans, the applicant must satisfy standard guideline ratios relating housing expense and living expense to income, even though the figures used might not be verified. However, with a no-ratio documentation loan, assets and employment are verified, but income is not disclosed or used in qualifying the borrower. The loan decision is based on the borrower's credit rating and down payment or equity in the property, and standard guideline ratios relating housing expense and living expense to income are ignored. Generally, the major requirement to qualify for such a loan is that the borrower has a substantial down payment and a review of the applicant's credit score, amount of loan desired, amount of documentation he is willing to provide. The guidance suggests that policies should provide for more diligent verification and documentation of income and debt reduction capacity as the level of credit risk increases. Stated income should be accepted only when mitigating factors clearly minimize the need for direct verification of repayment capacity. For most borrowers, income can readily be documented using recent W-2 statements, pay stubs, or tax returns. Furthermore, TILA prohibits underwriting of a higher-priced mortgage loan based on the value of the consumer's collateral without regard to the consumer's repayment ability as of consummation. Furthermore, TILA prohibits underwriting of a higher-priced mortgage loan based on the value of the consumer's collateral without regard to the consumer's repayment ability as of consummation. Simultaneous second lien loans. Simultaneous second lien loans involve use of a closed-end second lien or a HELOC originated simultaneously with a first lien mortgage loan in order to avoid the need for a higher down payment. These loans increase credit risk as the borrower will have little or no equity in the property and may have little incentive to avoid foreclosure if he becomes delinquent. Therefore, they generally should not allow for delayed or negative amortization without other significant risk mitigating factors. Introductory interest rates. When an introductory interest rate for a payment option arm is well below the fully indexed rate, borrowers are more likely to experience negative amortization, severe payment shock, and an earlier than scheduled recasting of monthly payments. Lending to subprime borrowers. Providers targeting subprime borrowers through tailored marketing, underwriting standards, and risk selection should ensure the terms of these programs do not become predatory or abusive. Recognize that risk layering features in these loans significantly increase risks for both the provider and the borrower. Regulation Z's provisions relating to higher-priced mortgage loans prohibit a prepayment penalty that will apply after the 2-year period following consummation, when the loan is refinanced by the same creditor or its affiliate, or if the amount of the periodic payment of principal and/or interest will change during the 4-year period following consummation. Extension of a first lien on a principal dwelling without an escrow account being established before consummation for payment of property taxes and any required mortgage-related insurance premiums. Non-owner occupied investor loans. For a loan to finance a non-owner occupied investment property, the borrower should be qualified based on his ability to service the debt over the life of the loan. The combined LTV ratio should reflect the potential for negative amortization and the need to maintain sufficient equity over the life of the loan. Underwriting standards should require evidence that the borrower has sufficient cash reserves to service the loan, considering the possibility of extended periods of property vacancy and the variability of debt service requirements associated with interest-only and payment option ARM loan products.